Brian Grimes, your real estate mentor, back with another action-packed session. Today, we're going to do a quick market update for you guys. There are a few things that I want to touch on. If you see on the side of the screen there, we're going to show you some of the worst states and cities for cash flow, some of the best. So if you're wondering where you should be investing, especially if you're looking into out-of-state investing, definitely stick around. If you're new to the platform, like, comment, subscribe. Leave a comment that says, I subscribed. For everyone who leaves that comment, I'm going to send you instant access to my free real estate training. It'll show you how to acquire properties for pennies on the dollar all across the country. You don't want to miss out on that free offer. If you're interested in any of our different trainings that we have for you, we have the real estate ride along as well. We have a ride along coming up March 23rd, which is a Saturday. I'm going to take maybe 10 to 15 people on a tour of the city of Philadelphia. We're almost sold out on tickets there. So if you want to tap in, there's still a handful left. Click the links in the description. You can tap into those. If you're interested in the Boots on the Ground program, just text me, DM me. The text will kind of be flowing around in this section, so you can kind of reach out. But we're pretty much at capacity on the Boots on the Ground program. We've had a bunch of people join, and I want to slow down new applicants to give some time for the people who've recently tapped in to get some deals locked up under their belt. So let's jump into this thing, guys. In terms of mindset, I mean, with real estate, you guys just need to think about trading your time for money. Trading your time for money and what that really means long term. Like, how long can you continue to work for other people and pour your time into something for cash? And then what happens if you're setting yourself up to only make money based upon you putting time into the 9 to 5 and working for other people? If that's your only strategy, what happens if you get sick? What happens if you get in an accident? How is your family going to survive? And then how long can you continue to trade your time for money? The problem with that system is eventually you run out of time. You get too old. You become obsolete. You're no longer valuable to the workforce. And as soon as that happens, you get replaced. I have some people that I know that are in different areas of the workforce where they're concerned about tech. They're concerned about robotics and automation and AI replacing them completely and just wiping them out of the market. What are you going to do? I'll say when that happens, because you're either going to get old or replaced and made obsolete at some point. If you don't have multiple streams of income, other sources of income outside of the 9 to 5, outside of the hustle and bustle coming in, you're going to be in a world of pain. You're going to get hurt in this game. So real estate is about having another stream, a way out. It's about building long-term wealth as well. And we'll talk about that during the session. But you have to have that stream of income coming in. You have to find a way. I just dropped a training. If you guys tap into the YouTube channel, I just dropped a training that breaks down 3 investment strategies that you can focus on. And if you apply your interest and your time and attention into these strategies, one strategy shows you how to do $1,000 a month of cash flow from one deal. The other strategy shows you how to do $3,000 to $5,000 a month. The other one shows you how to do $10,000 plus a month per deal. This is per deal. So $1,000 a month per deal, $3,000 to $5,000 a month per deal, $10,000 a month per deal or more. And there's other strategies where you can do more than that. I was just talking to a guy 2 months ago, I believe, who's doing, I want to say $30,000 a month per deal, $30,000 a month. But I'm keeping that strategy like very tucked and hidden because even the area that he's tapped into, they don't even want people talking about it. It's so hidden, so off the beaten path. But I'm telling you guys this thing to let you know that if you focus your time and energy and attention into the right strategies, you can build enough cash flow to retire like ASAP, even if it takes you long. And I do want to say this because some people will kind of watch and say, oh, well, of course Brian can do it. Or maybe he started off well above and beyond where I'm starting off. I started off broke, living at home, like in the bedroom I grew up in, right? I saved and studied for 2 years before I ever did my first deal because I was that broke. You know, working, making less than $20,000 a year, really grinding. So you guys can get there. You can get started and you can get to that next level. but you have to take the first steps. You have to focus your time while you're young enough, while you're healthy enough, on the right things. Because if you waste too much time or you keep trading your time for money, you're going to run out of time. And then how are you going to make money? Because you ain't going to have time to trade for money anymore. So wake up while you can and stay tapped into the stuff. If you're here, like, comment, subscribe, but share the content with somebody else who you want to get value, who you think needs to get free from the matrix, to unlock from this program, this brainwashing that we've all to a degree been brainwashed, which is why they don't teach you any of this stuff in school. They're programming you to be an employee indefinitely. The audio will get choppy from time to time. I'm going to tap out and tap back in, and then we're going to get into this. If you have questions, drop them in the chat section, comment section. I'll be right back. So let's get into this thing. And we already had a question come through. Guys, keep the questions coming, because I'll stop from time to time to answer the question. Let's just jump into this question, and then we'll kind of get into the market update. Only a handful of things to tap into. So I do want to spend a lot of time on you guys' questions. Anything that's bothering you about real estate, holding you back, keeping you fearful, just ask the question, get it off your chest, and give everybody else a chance to learn from it. If a tenant abandons your property, do you still go through with eviction to cover your bases? Not necessarily. I mean, if they abandon it and you're relatively sure that they're not going to come back, then just go ahead and change the locks, take videos, show that it's abandoned, send them a text saying, hey, haven't heard from you, assuming you walked away from the property, create that paper trail. And if you don't hear from them for a week, keep it moving. But usually I will never stop the eviction until I've kind of moved past that point. If you've gotten like they're out of the house for a week, they haven't paid, they're not returning texts, emails, you sent communications, you've documented it, you're pretty much covered. So to me, that's covering your bases, is creating a paper trail. And this will touch on another point. When you're managing your properties and when you're first getting started, I recommend that you guys use property management, because property management is going to show you the right way to do this. It's going to show you how to invest like a pro, how to cover your bases, how to manage your properties professionally. I recommend that you paper trail everything. Very little of my communication is over the phone with tenants. And even that is on a recorded call. And I let them know, hey, we're on a recorded call, and I have the software to record the phone calls. I have a CRM, a client relationship management program, and the software automatically records the calls. But even with that, I keep everything paper trailed and documented, because when you get into eviction court, you have to assume everybody's going to lie. Just assume everybody's going to lie and create that paper trail, so that if they're lying, you can just say, hey, judge, here's the text, here's the information, done. You know, that's kind of that. So creating that paper trail is important across the board, especially in these eviction situations. But even before you get there, when there's a problem with the sink breaks and there's a leak, paper trail it. When I fix it, I also will send a picture saying, hey, we just fixed it. Please confirm that you received this. Everything's good to go. Because if you don't do that, then the tenant's going to come back later and say, oh, no, they never fixed it. Even though you know you fixed it and you have documentation, you didn't send it. You didn't create the paper trail. So paper trail everything. Assume the lie. Know that that's going to happen in court, and protect yourself before you ever get there. They say, hey, fam, hit the thumbs up, support my brother. Definitely get those likes up, get this stuff out into the algorithm so that more people can get value. A big part of the real estate game is pushing value out into the game, into the universe. You have to give value to real estate and give time and attention and energy to the real estate. If you treat real estate well, it'll treat you well. If you just neglect it or treat it like everything else, or like it's a distraction to you, you got better things to do, real estate will have better things to do than provide you with cash flow. But cash flow is everything. Real estate, if you give it your time, it's going to give you cash flow, which is financial freedom, more time to spend with your family, traveling, waking up when you want, working out more, eating healthier, just having your time back. Having your time back is everything in life. That's why we're working. If you guys don't know that, you're working so hard, even at the 9 to 5, is because you believe one day you'll make enough money to have all your time back. You'll be able to retire. Well, you can actually do that in real estate. you're really not going to do that, in my opinion, working any 9 to 5 right now. But you can do that in this real estate game. So make sure you just give your time and energy and attention to it, and it will reward you. Brent said he's getting that free coaching right now, which is good. Would you put their things in storage or dispose? In that case, put it in storage. It has to stay in storage for 30 days. So it has to, typically with most municipalities, it has to sit in storage for 30 days. After 30 days, you can toss it. But before that 30 days, you want to keep it. So document it, take videos. I would take videos before I move the stuff. I would take photos, then I would get it moved, and you put it in storage, and then I would send them a text saying, hey, it's in storage, here's the fee. So I would make them pay the storage fee to get their stuff out. If they don't pay the storage fee, it's on them. And then if they don't pay for that locker, I wouldn't continue to pay. You want to make sure when you're dealing with these storage companies that you're not signing anything that allows them to attach this to your credit score. Somebody just asked a credit score a question, but attach it to your credit score or your credit or anything like that. But then if they don't come and redeem their things, the storage locker is going to auction it off. After 30 days, they're going to say nobody paid, and they're going to hold it for another 30, and then they're going to auction it off to the highest bidder. And it'll be like storage wars. Somebody will come in and grab all their stuff, but you'll have been compliant. So just make sure you're doing the right thing. The last thing I'll say on evictions, unless anybody has another question about it, is don't make these things super personal. Don't get into spitting matches with people. That usually happens when you don't have your paperwork together and you kind of don't know what you're doing, and people aren't paying. You don't know how to get them out. So you can get very frustrated. Things can get heated, intense. But as you get better, just get them out. Do the right thing, get them out. I'm going to tap out and tap back into this funding question. We got choppy audio today, and I'm going to keep this thing crispy. So I'll just tap out and back in from time to time, and we'll keep it clean. I got funding for flips, 80K max, 15 rehab max, 640 credit score. So guys, reach out. Definitely. You should text me or DM me and let me know kind of your company. Can you help identify needs of investors or new investors or one in their first win? Reach out. I'll drop a post on the Instagram and everything. People who are interested will reach out. But some of your information, there are a lot of good lenders popping up and new lenders. I actually just ran into one today where they'll even lend on like a 100-unit portfolio, scattered site, different properties. There are lots of different lenders popping up right now because of some of the things that we'll talk about today. There's a lot of demand out there. One more question and then we'll jump into this. Have you partnered with someone on a buy and hold? What is your strategy? You can partner with people on buy and hold. I prefer to tap into lenders. We just had a lender kind of throw some numbers up. I prefer tapping into lenders and leverage because they're cheaper to deal with than a partner. A partner wants 50% of your profits, and they're going to bring headaches with that. They're going to bring expectations. They're going to bring maybe drama, different ways of doing things. They may not be smart. They may be your partner, but still be competing with you. I've had a lot of, I want to say negative experiences with partnerships, but they're also positive because you can learn from them. But overall, what you ultimately learn is you don't need them. You don't need the partners. You'd be better off with a mentor, and you'd be better off with a mentor and a lender than a partner, because the mentor ain't going to take your profits, and the lender is just going to jump in. They're going to facilitate the deal. They're going to earn their keep by providing you with leverage, and they're going to allow you to do more deals with less of your own capital. And that's really what you're looking for. You think about what you're looking for from a partner. What you're looking for is leverage in terms of capital and resources, and you're hoping for knowledge, somebody else to share the burden. If I run into an issue, somebody you can bounce ideas off of, help you think through it, but they don't know anything. I've done over 300 deals. So who's a better person to bounce an idea off of, me or anybody you would partner with? Definitely me. Definitely somebody who's done hundreds of deals and has run around those bases multiple times. So partnering is usually, to me, a negative, and people run into a lot of pitfalls and horror stories. I've seen worse things happen with partnerships than scam contractors. Even scam contractor can hurt you this much. Bad partnership it's like infinite pain, essentially. Um, Partnership is like a marriage. So if you're going to get in a partnership with somebody, take it as slow as you would a proposal. I know guys that are in like the eight-year proposal. Like, hey, we're engaged. It's like, bro, you got that ring 8 years ago, bro. Like, but they're still not married because they're afraid of it. But they'll go jump in a partnership in 2 weeks. Hey, the guy had a good idea. We're just gonna make it happen. That partnership, you can spend more time with the partner than you would in a marriage with a spouse. So it's just something to think about. Somebody D said, yeah, you said it exactly. Partners left me in the bad situation. So in a bad situation, guys. So it's not just me. It's a lot of people I've talked to. A lot of people who are mentors out there I know real estate gurus out there who are like, and I don't consider myself a guru, but I know real estate gurus out there who've been in horrible partnerships, and that's what they preach. That is what I preach. Partnerships, you don't need it. You think you need it when you're new. You need mentorship and good lenders and leverage, and you'll be way better off. Have not credit score dropped. The opportunity I'm offering to help others, but I'm not sure what you're saying. But like I said, reach out if you have information. DM me. Happy to post it to the stories, get it out to some of the people. Everybody will kind of take a look at it, and people who are interested will reach out. It's always good to have multiple lenders. You guys know I preach that. You don't want just one lender. You want to have multiple. Have 3 lenders, 3 credit cards, 3 hard money lenders, 3 portfolio lenders, 3 credit unions, 3 local yokel lenders. Have a bunch of lending relationships, because you never know when one is going to kind of die out, fail out of the game, shift gears, and another person can kind of step up. So let's get into some of this kind of market stuff. I wanted to find a couple of articles for us to take a look at. This one was interesting. It's a map that kind of breaks down the 10 worst cities for single family rental cash flow. And then we'll tap into some of the best. The worst cities are on the West Coast. So many people come to me from California and those markets on the West Coast, all the way up into Washington. We even have some in like Massachusetts, Maine. Florida is really horrible. I was talking to somebody earlier from Florida, South Florida in particular, where the prices are crazy. There's no cash flow in some of these markets. And this game is about cash flow. You will hear some people out there say, oh, you should just don't worry about cash flow. You can get wealthy off of appreciation. Not really. You want to buy in markets where there's a lot of cash flow. The cash flow is typically in the Northeast. It is not on the West Coast. It is not in some of these other markets. And we're going to tap into the markets where the cash flow is. I'll be right back. We're going to tap into the Northeast markets and show you where the cash flow is. So the best cash flow is actually in some of these markets. These are the top 4 best cities for single family rental cash flow. And knowing where if single families are cash flowing here, multifamilies are cash flowing here. So you're not going to see like, oh, the singles aren't cash flowing, but the multis are. No, you're not going to see that. The singles are cash flowing, the multis are just going to cash flow more, maybe a little bit less, in the sense that if you got 2 singles, maybe it cash flows more than 1 multi. But Detroit, Michigan is coming in at the highest because more or less because the price range of the average property is a little bit lower. I will say about Detroit, one bit of caution is they're not cash flowing everywhere. And there's a lot of vacancy in Detroit. There's definitely a lot of vacancy there. The market is a bit more specialized there. You just have to be careful. There is cash flow, but there are markets that I like a little bit more than Detroit. If you are out in that market, definitely tap in there for cash flow. Buy the properties. You're going to be buying cheaper properties that are going to appreciate over the course of time, and you can get good cash flow. Jackson, Mississippi is good. I talk to a lot of people from this area, and I would say the number one thing they struggle with is just analyzing deals. Deal analysis can be a struggle that a lot of us deal with. We don't know how to project cash flow. We don't know how to run comps. We don't know how to build rehab budgets. We don't know the cost of lending and leverage. And you need to know those things. That's why in our one-on-one mentorship program, we have deal analysts on staff that will crank the numbers on deals. So we'll have our people send us deals that they're seeing if they were in a market like Jackson and say, hey, Brian, can you run the numbers? Can you guys look at this deal? And we'll project the cash flow, run the comp, show you how much a deal can make you annually. And some of the cash on cash returns I'm seeing in most of these markets is like 80 to 100% cash on cash return if you know the right way to structure these deals, which we know. Cleveland, Ohio. Cleveland is a huge market. Ohio, there's Columbus, there's Cincinnati. Ohio has high cash flow, low vacancy, as you can see, the lowest on this chart of the top four. It's, I will say, that's been a market that I've seen develop a lot over the course of time. Over the last 5 to 10 years, a lot of developers that I've seen in other cities across the country have been eyeing Cleveland and are all kind of going in droves and in waves. So I would expect valuations in Cleveland to continue to rise. These properties that you're buying for $50,000 to $60,000, you could buy some singles for 40, 50K. They're going to double or triple in value. You're going to make a ton of equity, and you're going to build serious wealth buying in a place like this. If you're in California and you want to buy in Cleveland, you just need to learn the systems that allow you to invest out of town. That's all you need to learn. And there's a simple way to do it. There's a way to make it relatively passive where you're just managing the manager. You just need to get dialed in, tapped in, and kind of learn how to invest out of town. Investing out of town is a wave right now, which we'll get into next in the next article. But it's a wave. And once you learn how to do it, you're going to be part of that wave. And you want to get in on that action right away. And then we have Birmingham. Here's the top 10 cities for cash flow. So if you're in any of these cities or around there, make sure you're buying. So we got Detroit, Jackson, Cleveland, Birmingham. We have a spot in Florida, Lehigh Acres. We have Baltimore. You guys know I'm talking about Baltimore all the time, and I'm in Baltimore. I'm buying up in Baltimore, and I've been buying in Baltimore for the last decade. So high cash flow there. Philly, also there. They should probably have different parts of Delaware here, like Wilmington, Delaware here as well. But these are my two favorite markets, Philly and Baltimore. One, because they resemble each other. They're sister cities. Baltimore has DC. People get priced out of DC. They move to Baltimore. Philly has New York. People get priced out of New York. They go to Philly. So you have those sister city guaranteed inflows of people who are coming from more expensive cities down there, bringing their money, bringing their pocketbook, and being able to have that high purchase power. And that's important. And then we have, Montgomery, Alabama, Toledo, Ohio, another market in Ohio. Memphis is a good market. There's actually a lot of big brick built like quadplexes in these types of markets as well. I also like Baltimore and Philadelphia, even over some parts of Cleveland and Detroit, because Cleveland and Detroit, Jackson, Birmingham, and Florida, these are freestanding markets. Cleveland will have some row homes, but not nearly as many as these two cities. These are row home cities. And the reason why we like row home cities is because they're very cheap to develop in. Row home cities are connected like a townhome with a house to the left and the right of it. They're all connected by party walls. The beautiful part about a row home is there's very low cost that goes into the exterior of that property, because you really only have the front and the back facade and then the roof, and it's usually a flat rubber roof. So $10,000, you can pretty much bang out the exterior of a row home, versus a freestanding house in Cleveland. If you had to go and do all new siding and new roofing and everything else, 40, 50,000. I'm going to tap out and come back in. We're going to jump into a few questions, and then we'll get back into more. So let's jump into a question. Petrinia says, how do you build relationships with lenders? You just have to contact them. Lenders are in the business of handing out money. Lenders they're essentially like sharks. They say a shark, if it doesn't If it's not swimming, it sinks, it drowns. So lenders are only making money when they're lending it out to developers. So you just have to call them and say, hey, I'm a developer. I'm looking for relationships. I'm sourcing deals actively. And when I have something, I'm going to bring it to you. I'll say that lenders almost hate new relationships for whatever reason, but then they love when you do one deal with them and now you're a pre-existing relationship. Then they roll out the red carpet. They don't like new people because, they don't know who they can trust. You never know, especially you're giving somebody like $250,000 to do a deal. You never did it with them before. It's unnerving. But once you execute, lenders love you. So it's really about building as many relationships as you can early on in your journey when you're just getting started. The best way to do that is to just reach out, contact them, tell them who you are, have a game plan. But I would say it helps to be in some type of mentorship program or have done a deal before, just have a general knowledge of real estate, because no matter who you're dealing with, and I said this in a free training I dropped, if you're dealing with lenders, architects, engineers, permit expediters, contractors, partners, whoever, they're going to know you're new by the way you talk, or they're going to know that I'm not new by the way I talk. If you're in a mentorship program and you're going through the course content and you're learning and you're picking up the jargon, when you go to call that lender, you're going to speak differently, and they're going to hear it. Just the words you're using, the confidence is kind of coming through. You have a plan. You sound more educated in this game versus somebody who's like totally new. You're going to get a different treatment depending upon how you sound. So educating yourself first before reaching out to the lender is important. It's really important. But once you do that, you can build relationships easy. Like today for me, building a new lender relationship is effortless. Just call them, talk to them. I know how their business works. Some of these lenders better than the people who are answering the phone, like by a mile. I can explain their job to them and how everything works and where the money's coming from the lender, how they're getting the warehouse line and how everything works behind the veil that the people on the phone, on the sales team, don't even know. So that allows you to build relationships a lot faster and get you to the next level. Equity only makes you rich when you sell, right? People speak to pulling out equity like it's free. I mean, you can tap equity. You can do cash out refinances. You can do HELOCs, home equity lines of credit. You can get your hands on the equity, but you want cash flow. You want cash flow coming in because that's what's going to get your time back. Equity will happen naturally, in my opinion. If you're buying the right deals in the right markets, in these affordable markets, which we'll talk about next. If you're buying deals in affordable markets across the country, naturally these properties will return to their inherent value. So what does that mean? If you look at your insurance policy, if anybody who's watching this owns a house, look at your insurance policy, look at the replacement cost of the property. So if the house burned down, the replacement cost of even a property in Cleveland that you bought for $50,000, it's going to be like $250K. Because if you tried to do a ground up deal, no matter where you did it, you could do it in the hood of Camden, you could do it in Cleveland, you could do it in Baltimore. It's going to cost you $200,000. It's going to cost you XYZ per square foot to go ground up. So that cost is kind of there. So even if you're buying in a city for 40 or 50,000 in a cheaper city in the Northeast, in some of these high cash flow areas, the inherent value of the property is still 200,000. That's the cost of the bricks, the structure, just the existence of that building itself. Over the course of time, if you hold on to that property, it will return close to that inherent value, if not surpass it over the course of time, because it's just part of the natural ebb and flow of things. So buying in cheaper areas is the way to allow your property to double or triple or quadruple in value. And I've had properties do exactly that. Not just some, like most, I'll say, with the strategy that I teach and where I buy and why I buy. But if you're getting cash flow the entire time while your property's doubling and tripling in value, now you're going to get really wealthy. And the rents are going to continue to go up as well. So if you're cash flowing today, as rents continue to go up, you're going to cash flow even more tomorrow. And that's important for you. So yes, equity can make you wealthy, but you want cash flow now, because cash flow is going to buy your time back. Once you get your time back, you can do more deals per year. So if you're still working a 9 to 5 and you're tapped into the right resources and relationship, maybe you have like hey, you're in a mentorship program, you have access to somebody's team and leverage, or you're in a boots on the ground program where you're kind of building the houses for you, you can do multiple deals. I just had one of our boots on the ground members, they just put 3 deals under contract today, like at once, a package deal. And they just took it. So you can do that. You can do multiple deals. But as a lone wolf, if you're just trying to do this by yourself, you're only going to be able to do a handful of deals while still working. Not that there's anything wrong with that. But as you continue to scale a handful of deals, you build that cash flow. Now you can take a step out of the 9 to 5, do more deals. And now you can do 10, 20 deals a year. I'm going to tap out, come back, and we'll keep going. So I thought that this one was interesting. I found this chart, and it breaks down. Let me get this a little bit bigger. It breaks down the share of housing units owned and occupied by single women versus men. And I'm not even sure how I stumbled upon this. There's certainly been demographic changes here over the years, but in almost every state, it's like single women. If you take these two groups, single women versus single women, except for North Dakota, are owning like way more real estate. Look at Maryland, 14 versus 8%. Pennsylvania, 13 versus 10%. Carolinas, Virginia, 13 versus 9%. Florida, 14 versus 10%. Women are outproducing men in this game. And I anecdotally have noticed that even as somebody who provides, one-on-one mentorship, who's enrolling in mentorship, who's going out and getting results, who's more fearless. And it's like the ladies are more fearless, man. They're going out and buying this real estate and building cash flow. It's not that they get it more than some of the men that I talk to, but I think that some of the fellas have a little bit more ego, a little bit more foolish pride, and want to truly go out and believe that they're the chosen one and they're going to learn from the school of hard knocks and just figure it out. Whereas I see the women are tapping into mentorship a bit more, educating themselves a bit faster, and are more fearless and are going out and just grabbing this real estate. So I think it's something interesting to see. I'm not quite sure what's behind it, but it is nonetheless an interesting demographic breakdown to say, like, wow, in most of these states across the country, and I'll include links in the description of this video. So if you're watching like the replay, you'll be able to tap into some of these links. You can kind of go through this stuff and see kind of the demographic shifts over the years. It talks about the gender pay gap and kind of breaks down some of that stuff. But it's interesting, man. This is becoming a renter's nation, and the ladies are picking up on it and grabbing their piece of the pie. And I think that that's just extremely interesting. It's something I did not expect, but it's something that's happening nonetheless. Here's one thing that we need to concern ourselves with as we're continuing to invest in real estate. Real estate investors who buy up single family homes could get taxed under new bills. There's a lot of stuff coming out that is, I guess, targeting people buying single family rentals in particular as investment property. So this one is targeting if you own 15 or more. The Affordable Housing and Home Ownership Protection Act would impose a transfer tax on investors who purchase and hold more than 15 single-family homes nationwide. So it doesn't matter what state you're in or where you're at. They're thinking that the revenue would provide up to $50 billion over 10 years to help build and preserve approximately 3 million affordable housing units. We'll see. From my perspective, I don't know that that's really going to provide more affordable housing. Taxing developers and investors usually does not solve the affordable housing crisis. I mean, that's been happening since the beginning of time. More taxes, more taxes. We still have an affordable housing crisis. So I don't think that that's going to help. But it's important to know that there's a window of opportunity right now where these taxes and these hurdles, they don't exist. The market is wide open for us. And I think a lot of us are taking it for granted. We're not really paying attention. We're not looking at this. We're not anticipating that rates are going to continue to fall as we get closer to 2025. and that might not last. There is a window of opportunity for you guys. And there's a wave as America becomes a renter's nation. There's going to be a lot of pushback from different legislative groups that are going to make it harder to do what we're talking about doing right now. This is a golden age, a golden opportunity to go out and grab 50 to 100 properties, hang on to them, and cash flow. Once these groups get their hands on this stuff and start taxing you, it's not that you're not going to make cash flow and that it's not going to look good still. It will, but it's less attractive, less cash flow, more money out of your pocket. So now is the time to really start focusing on this because everybody's buying. There's this other article that I tapped into, and it talks about the investor appetite for affordable homes. It's hitting a record high amidst this housing shortage. So according to data, let me blow this up a little bit. According to recent data from Redfin, the landscape of the U.S. housing market is witnessing a significant shift, with investors increasingly setting their sights on the country's most affordable homes. In the fourth quarter, a record 26.1% of low-priced homes were snapped up by investors, underscoring a growing trend that is reshaping real estate dynamics. So more and more investors are waking up and saying rates are high or higher than they were over the last 10 years. Prices are going up. Inflation is here. I want cash flow. And they're going in to those top 10 cities that I broke down for you guys. We'll pull it up again. They're going into these top 10 cities and they're buying all the freaking real estate. And they're buying the cheapest properties first. I'm going to talk about why that's important. I'll be right back. I think this is extremely important because you have hedge funds. They're buying all this real estate. They're buying essentially all of the Midwest because the Midwest is easier to predict than some of these Northeast markets like Baltimore, Philadelphia, even parts of Cleveland to a degree. But Cleveland's being bought up by hedge funds too now. 5 years ago, I know hedge funds that wouldn't touch Cleveland, and they had a negative viewpoint on that. I don't know why, but a lot of lenders didn't believe in it. Now they believe in it. They're buying it up. They're going after the cheap value add properties, and other investors are doing it as well because they know that if you buy a cheap property and do that BRRRR strategy and value add it, you're not only going to get the cash flow, but if you do the cost segregation study and the analysis on the property and you bonus depreciate it, you can wipe out a lot of your W-2 income. So you can wipe out a lot of your 9-to-5 income and take massive tax losses and get tax returns. So it's very important. And everybody's starting to wake up to this stuff. Everybody's starting to wake up. And if you don't wake up, you're just going to get left behind. They're going to eat your lunch because it's a trend now. And I think that trend is growing because rates are higher. When rates were lower, people could buy almost anything and make cash flow in some of these markets. Not really in California still because of the price to, I'll call it like the price to earnings ratio for the average American and what the affordability of the single family starter homes are in a place like California. It's like 20x the median income. But you got to grab your deals right now. You got to grab them. Roland said, hey, Brian, I'm grabbing 50 to 100 deals. What's the fastest way to stabilize a property? And what ways can you finance them without running out of money? You guys got to buy them. The fastest way to stabilize them is market rentals. So just going out and finding people who have cash and who want to move in. I know that sounds simplistic, but the alternate to that would be like Section 8, government housing, voucher-based housing, where you need more inspections and qualifications and moves a little bit slower because government agencies aren't known for moving fast. So going with something like Section 8, you can stabilize, but it's slower. So you don't really want to grab a 100 property portfolio that is vacant, not that there are many of those, and then try to Section 8 all of it at once because it's going to take a long time to do it. It's going to be good when it's done because then you have government money coming in to pay those rents, pay those mortgages off. But, going out and just grabbing regular market tenants, people who are in that workforce, I'll call it workforce housing, people who are working, driving Uber, working at Walmart, just working regular jobs, and you can buy affordable housing in some of these cities. All of these cash flow cities, Detroit, Jackson, Cleveland, Birmingham, these are all workforce housing cities where, the real estate prices are very cheap. I mean, I'll pull up the chart here. You can see, we'll blow it up. This is showing you the typical price. I can't really highlight it, but it's showing you the typical price: 69,000, 97,000, 97,000. Jackson's like 69,000. So you can buy properties pretty cheap in some of these markets, and then you can stabilize them with regular market tenants. Typical rent's $1,200, $1,150. A lot of people can afford that for a starter home, and you're going to make your money really fast. And in terms of what ways you can finance them without running out of money, it really is the BRRRR strategy. It really is buying properties. It's not about financing them and not running out of money. It's about identifying properties that you can purchase for pennies on the dollar, and then having the knowledge to put them together at a price point that allows you to refinance all your money back out of the deal. Because then you can recycle your capital. So I'll say that again. If you could buy the property, maybe you took $25,000 out of your pocket, you bought the property, you got a lender, you rehab the property. Maybe it's cosmetic, you put 25 grand into it. And then at the end of the process, you got a tenant. They put in if we did this in Detroit, they put in I'm going to blow it up for us. In Detroit, we bought it for let's say the typical price is 69,000, right? Let's say we bought it for 25,000. It was a steal. We put in 25,000. We were all in at 50. It was worth 70. We find a lender that'll let us refinance out as much of our money as possible. And they say, look, we'll get you 50,000 out of it, so we can get all of our money back out of it. Then we go rent it out for $1,200 a month, put a mortgage on it. We're cash flowing $700 a month. And then we have our 25,000 back in our pocket. We can do it again, do it again, do it again. That is the game. Once you set up that structure, it's over. You can do that 50 to 100 deals in a year. You can stabilize them with the right teams and systems. If you're running at that clip, 50 to 100 deals, and you get a couple of virtual assistants, a couple of people who can kind of lean in, help you with tenanting, help you with screening tenants and managing tenants, and you can find enough leasing agents or tenant placement groups that can run at a clip. You might need 3 different tenant placement groups. Give each of them 5 properties at once. Let them run through them, and then line up another 5 behind those. You can set up an operation where you can successfully operate rehab and tenant, 50 to 100 deals a year. But don't necessarily have the goal of doing that many deals. And I'll tell you why when I come back. So, well, somebody said I'm in Toledo, Ohio. I'm missing out. You're definitely missing out because you're in a super high. I mean, you're on the top 10 list. If you're on the top 10 list and you're not tapping in, you got to get in the game because you're sitting on a gold mine. I mean, it's literally out here. Everybody knows it. The reason why you don't necessarily want to have that goal of doing 50 to 100 a year is because you just want to find the sweet spot. You want to find a profitability point where you can go out and comfortably tenant with your strategy. So if you have a Section 8 strategy, there's nothing wrong with that. Maybe that sweet spot is 15 deals a year. I can go out, I can buy them, I can Section 8 about 10 to 15 a year comfortably. I'm not dragging them, I'm not carrying them, there's not a ton of vacancy. That makes a lot of sense. You want to go with that strategy and you want to grow at that pace. If you try to grow at 40 and then you can't tenant them fast enough, now you're carrying a ton of mortgages, you're bleeding out money. It's not profitable. So you want to grow at a profitable pace. For some of us, that profitable speed might be 2 deals at once. It might be 2 deals every 6 months. It might be 1 deal every 6 months. It depends on where you're at, how much knowledge you have, how much resources and relationships you have, what type of lenders you have, what type of mentorship you have access to. All of these things are going to impact your speed and your exit strategies. If you're doing things like co-living, I just help somebody to tenant their co-living portfolio. And the beautiful part about what we've done, because I've done I've done co-living the wrong way, where you just try to sprint people into the houses as fast as possible, and then they don't pay. You pick the wrong tenants. We went at a pace that was probably less comfortable for the person we were doing it for, but the payment rate is 100%. And when you're collecting 100% of the rents in co-living, you're cash flowing over $1,000 a month per deal. That's just how it rolls. So if you can do it the right way and take your time and grow at the right speed, you can tenant, even in something like co-living, you can get 100 co-living units in a matter of a handful of years, where each co-living unit is paying $750 a month, and you'll be cash flowing $30,000, $40,000 a month after all expenses by taking your time. So don't get caught up in hundreds of deals. And I know I've done over 300 deals, right? So it almost feels like hypocritical. Like, well, Brian says don't get caught up in doing hundreds of deals. He's done 300 deals. And in my biggest year, I've done over 100 deals. My biggest year was like 150, 153. But that's what I'm telling you. That I don't think that was the most profitable year. That was just the biggest year in terms of acquisitions and execution. But what I've learned is there's a sweet spot. There's a diminishing rate of return. And that's good news for you guys. That means you don't have to go out and do a bazillion deals. And some of you never want to have that many properties, which is perfectly fine. You don't need that many properties to break free from the 9-to-5 and retire. You could do that with really one deal. If you do the right type of deal, take your time. Or 5 to 10 deals, you could be done. So pick the strategy, do what works for you, and take your time. And you'll be essentially good to go. But definitely, if you're in Toledo, make sure you're tapping in. Just go out and buy a couple of properties. What's the average? I wish they had the average price in Toledo. I don't think they have that listed here. I bet you the average price of a property, I bet you could buy properties for like $40,000, $50,000 in that market. And that means you could get a mortgage and get them for even less. So I would say stay out of these worst cities. These are like negative cash flow cities, negative $4,000 a month. It's crazy. Get into the Northeast pocket. We have the Boots on the Ground program in Philly, which is number 7 out of the top 10 cities. I don't even know how many cities there are in America, but to be in the top 10 is important. We have the Boots on the Ground program in Philly, where we can find the properties, build them for you, tenant them for you, manage them for you. And we did a breakdown in the last live session. We still have it on the board, on the whiteboard behind me, where we broke down the numbers. That guy's going to be cash flowing over $800 a month on that deal, and we just got a voucher, Section 8, for another one of his properties. Probably cash flow another $800 off that, $1,600 a month coming in. And we found them, renovated them, handling all of it. So that's $1,600 a month coming in. He'll probably hold on to those properties for the rest of his life and then go get more. I hope he gets another 10. If he's already at $1,600 and we did that through the Boots on the Ground program, if we just keep going, he's going to get up to $16,000 a month. That's life-changing money. $16,000 a month, passive income, cash flow. I know guys that I've seen build up to that level as well. And it makes you unbreakable. It's almost unexplainable. But I've seen guys get up, $20,000, $30,000 a month. You could be less. You could be 10. And you could go out and make a bad investment. Oh, I had 80 grand, blew it. Contractor ran off with it. They fall back. Everybody makes fun of them. 8 months goes by. They stacked up another 80. They're unbreakable. You can't beat them because the cash flow wins. So building up this cash flow is a game changer for life. It's as serious as a heart attack. I'll be right back, and then we'll tap into some more questions. Keep the questions coming. Okay, we got a couple more questions. Will lenders use your personal credit as a guarantor when refinancing in the business name? Yes. So they're typically going to use your personal credit. They're not really using the business credit. They're going to have you guarantee the loans as well, personally, even with the business. So you can essentially create an LLC and close in it. You don't need like this 2-year LLC to do a deal or anything like that. you don't even need a LLC to do a deal. If you're doing a BRRRR strategy deal and you're taking on lending and leverage, you typically will want an LLC. If you're doing an FHA, that has to be, which is a first time, home loan. That has to be in your personal name. So you can't do that in an LLC or in a business name. It has to be in your name. So you don't want to go open up an LLC. I've seen people do this, and then they're doing an FHA loan. And I'm like, well, you didn't need the LLC. That was a wasted $500. So that's something to know. But definitely, they're going to use your personal credit score. There are specialty lenders that will, go below 600 credit scores as well. So depending on where you're at, you're going to have options. That's one area where mentorship can be really important, because when you're new and you have kind of, I'll call it compromised credit, or you're working on the credit, trying to build it back up, sometimes you're going to get some no's from lenders. And if you don't have like a mentor who continues to push you, or it's like, bro, that's just one no, keep going, or talk to this guy, or I have some other options, a lot of people just get disenchanted and just quit. But if you keep going, you'll get the yes, you'll get the deal done, and you'll improve your credit, and you'll kind of keep flowing. If you have a 2-year construction loan expire and you're bleeding carrying costs, refi and finish, or cut your losses. Well, how would you cut your losses? I would always refi and finish. The way out is, further in. The way out of the cave is further into the cave, through the cave to the other side. You have to follow the light to get to the other end of the tunnel, to the other end of the cave. So typically it's going to be refinance, finish it. You can try to cut your losses and sell it to another investor. But I would say if you're in a 2-year construction loan, you need mentorship. I'm not saying you're in it. I think this is like a hypothetical, but get with somebody who can help you to get out of this deal. And you're just in it too long. There's no need to be in a construction loan for your average deal. Maybe this is a ground up deal. I don't know enough about it. But if it's like your average rehab on like a single family or a duplex, get with somebody who can help you to navigate this deal, get out of it, do it successfully. Don't just kind of walk away or abandon it. And then game plan, like reshape your game plan, reformat, recover, regroup, go back after it. But I would say connect with somebody that can help you to think through the deal. It's a little bit too long to be in a rehab project, but you would want to refinance into cheaper lending. Get out of that construction loan, because those rates are like 12 to 15%. What was the process for tenanting co-living? Average time to full occupancy? It's a good question. Co-living, when you here's a funny wrinkle of co-living. Let's say you have 3 units in a property. You took a single family, like my traditional co-living. Take a single family, 3-bed, 1 bath, rebuild it into 3 beds, 3 baths. The first 2 units will tenant quickly. They're going to tenant the fastest. It's almost better to try to tenant the whole co-living building all at once. But before you move in the first person, get all 3 tenants lined up, get all the deposits, get everybody locked in, move them all in at the same time. Even if you're delaying a couple from moving in, getting the money, but pushing them back a couple of weeks. Because when you get the first 2 in, it's harder to show that 3rd unit clean and get that 3rd one full. That one will take the longest. Also, there can be adjustments. So there's like, when you think about co-living, you're typically going to have 2 units on the top floor, 1 unit on the bottom floor. The unit on the bottom floor is usually in the back of the house, and that, in a row home at least, and that gets private access to the backyard, because in a row home, there's only one way to the backyard, it's to the back of the house. So that unit can tenant for more, and it will fill the fastest. The units on the top floor can tenant slower. And if one bedroom's smaller than the other, you may need to play around with pricing. So I would say on average, for just to tenant 3 units, I think you could do it with the right team. You need everything to be right. So there's a process, there's a way to show the units, there's a way to market the units, there's a way to set up your tenanting team. And you have to realize that almost nobody does this. So I do this for our people in Philly who want to do co-living. Nobody else in Philly does it but me, because the property management companies don't understand it. They've never done it, and they're afraid of it. So I'm really the only one to do it. And I've built the team and trained the team to do it. So I can do it, 3 units, 30 days, maybe 45 days if that last unit is taking too long. But that property is going to cash flow $1,000 a month. Whereas a regular tenant placement company might take 3 or 4 months to do it, if they do it at all, but they don't understand the product. I'll be right back and I'll tell you more about the specifics of this. Now, this guy that we did it for, he had 21 units, 21 co-living units, so substantially more across multiple properties. So scattered site, 21 units, duplex co-living, which is 6 beds, 6 baths. So there's going to be a different speed at which you can tenant the first floor versus the second floor, because in a duplex, or the third floor, because now you're convincing somebody not only to do co-living, but then to have that walk up. So there's all different types of wrinkles and obstacles and price points. Sometimes let's say if I have the bottom floor is renting for $800 a month and the top unit is renting for $725, those tenants will talk because they're sharing a common area. So there can be tension. They're like, oh, why am I paying $800? They're paying, and you have to, no, you're getting more value. You're getting the backyard. So there can be some pushback there. But it can take time. Like the more units you try to do at once, the longer it can take, because now you're showing people multiple units. You're doing a lot of showings in a day. People can get lost in the process. There's more variables. When you're doing a duplex versus a single family, there's another hurdle because there's more people in that building, and then there's different levels of walk-ups. So it all depends. It really all depends, and it depends on price point. But the rule of thumb is go slower. Go slower. When in doubt, go a little bit slower. I don't want you guys in a deal for years, 2 years, but go slower and get quality over quantity. Get the paying tenants, because you don't need a tenant that don't pay. You'd rather wait a month and get a tenant that pays than go fast and get a tenant that doesn't pay. That's hustling backwards. So it makes you feel good. I'm tenanted, I'm good, and then they don't pay. Or they pay for 1 month, they don't pay again. So going slower allows you to get the quality. And once it's in and everybody's paying for a year, you're cash flowing month over month over month over month. Now you can win. And then when somebody moves out, you can tenant quickly because your team is dialed in. So co-living it's a great strategy for cash flow, but it's specialized. Like you almost have to build your own systems, or you're going to have to talk to somebody like me who's built this thing, who knows how to market and list them and show them and build the lease out for them and kind of do everything. So it's definitely still specialized. There's very few people who do it, understand it, and you'll be very hard pressed to find a tenant placement or property management company that's going to handle co-living because they're afraid of it. What do you anticipate when do you anticipate the first interest rate drop? Have the real estate lenders actually lowered their rates? They've been kind of fluctuating up and down. Rates have been kind of going back and forth. I'll say rates will continue to drop as we get closer to 2025. But you don't need to really worry about rates as much right now because rents have gone up. Rents have gone up in all of these top 10 cities. So because rents have increased to offset rising interest rates, you can cash flow right now. Even at today's rates, you can cash flow right now. You can cash flow right now. So you don't have to worry about it. You just need the right strategy and cash flow today. When rates drop, refinance into the lower rates and unlock more cash flow. So I wouldn't even think about it. Just know that it's going to happen. When it does, you want to already be a real estate investor. You want to already be locked in, tapped in. Because if you wait on the sidelines, if you're waiting for rates, by the time it happens, there's already trends. There's already people watching. There's already people buying up, all the birth strategy deals and getting locked in. You're going to be too far behind the pack. You're not going to have the systems and resources. So it's going to happen. It's happening. It's ebbing and flowing. And yes, lenders are adjusting, but rents have increased. there's been inflation of rents, and that's helped us tremendously on the cash flow side, which is why, if you're cash flowing, if you're making 700, 800 a month on a deal, what do you care where rates are? Who cares? If they go lower, refinance out, that $800 a month in cash flow goes to $1,000. That's a good deal. How do we tap into the Boots on the Ground program? Just reach out. Like I said, in this one of these areas of the screen, you can see kind of the information scrolling around. There's a number you can text, that 215-398-4709. You can text me there to get tickets to the real estate ride along, March 23rd. That's going to be an epic ride along. I just had 2 more people tap into that today. We're running out of tickets. So make sure you tap into that ride along. I don't know when the next one will be. This may be the last one we do for a while. So make sure you guys tap into that ride along. And then you can reach out about the Boots on the Ground program as well. The only way in is to talk to me one-on-one, see if it's a good fit. If it's a good fit, we'll lock you in. But like I said, we just had maybe 5 or 6 people tap into the Boots on the Ground program in the last month. So the demand is increasing. People are tapping in from the West Coast. I've had people tap in from outside of the country. We've had somebody tap in from New Zealand, right? From way out. And he's got 2 deals under contract right now. He's probably going to close on one in a couple of weeks, and we'll start building that. So if you want to get in the Boots on the Ground, reach out, and we'll talk about it. We'll see if it's a good fit. But the overall objective is to find you a deal and build you some cash flow, or flip it and make some money flipping it. I'll tap out and tap back in. Yeah, so definitely, reach out about the Boots on the Ground if you're interested. We've been really focused on cash flow deals like Section 8, unlocking as much cash flow as possible for people. And then we'll manage the properties in-house at 5%, industry standards 10%. We do that 5% for our people so that you guys get more cash flow. It's the Boots on the Ground program is transparent. It's fee-based, month-to-month subscription service. I don't have the capacity to build houses for everybody. I just don't. It's one thing I just can't do. I mean, I can't even do one-on-one mentorship for all of you who want it or need it. I definitely can't build everybody houses. I have a big team. We could probably do in the Boots on the Ground program, probably about 50. I would say we probably cut it at about 50 to 60 deals at once. And I don't even want to do that because that's like my hair. I got like a nice low hairline. My hairline's be back here. We get up to 50, 60 deals at once. I'll have to rock the permanent baldy because it's just too much work, too much stress. But if you're interested, definitely reach out because we're essentially out of capacity. I'm going to have to start waitlisting people, unfortunately. And then when some people kind of take a break, like I just had one group, they just finished their first deal. We're going to Section 8 it. They're going to take a break until we're done Section 8ing it, and then they want to come back. When somebody takes a break, then it can open up a space for somebody to come in, and then we kind of keep flowing from there. Maybe their break gets extended because it's like, sorry, we need you to kind of stay on the sideline for an extra couple months, let somebody else get some deals in. But definitely tap in. Boots on the Ground is just about taking your time, finding the right deal. The philosophy is the same. Take your time and get the right deal. I've had people come into the Boots on the Ground program and get a deal in 14 days. I've had people come in and get a deal in 90 days. And it just takes longer for whatever reason, whatever rhyme or reason. The market was slower. Things weren't moving as fast, whatever it may be. But the only thing that's important is that the deal that you get is the right deal. That's the only thing that matters. Even if it took you longer, 90 days to get a deal, it does not matter. It just matters that you get the right deal. Like, for instance, my mentee who got a deal, he got that deal fast. I think within the first 30 days, he had 2 deals, and each of them will make him $800-900 a month in cash flow because he unlocked his HELOC and used that to get those deals done. So his lending costs are very low, friction very low. But what if it took him 90 days to get those deals instead of 30? He's still going to cash flow $1,600 a month off of those deals for the rest of his life. I studied and saved money for 2 years before I got my first deal. So to me, 30 days, 14 days, 90 days, whatever. Cash flow is cash flow. It's going to change your life. It's going to transform everything for you anyway. So you don't need to be in an extreme rush. In fact, being in a rush, getting the wrong deal is hustling backwards to me. I'd rather wait an extra 30 days or extra 60 days to get the right deal than to move fast and get the wrong deal and then wish I had waited. Because once you get the deal, you got to keep it. It's hard to cut the loss and walk away. You got to keep it. How much do you think we need to get started? Need to start without doing wholesaling? So I guess we'll answer with wholesaling and then without. With wholesaling, you can get started with wholesaling with less than $10,000, less than $5,000. You can get started as a wholesaler. If you want to invest without wholesaling, there are different levels of numbers because there's a lot of leverage out there and lenders out there. I mean, you could get started with about somewhere between 15 to 20,000. A lot of people are shocked to hear that my first deal, I actually was only out of pocket 7,000, but that's because I know a lot of aggressive sellers assist and different types of financing strategies that allow you to bring less money to the table. And I did a FHA house hack, so I came to the table with very little on a duplex. I call it a triplex sometimes because I had an illegal unit in the basement that I was going to live in. But you can come to the table with very little if you're doing a house hack. If you're doing house hack, 15,000 or less, you could house hack in the right market. If you're looking to do like a BRRRR strategy, I would say you want 20,000 or more to start the BRRRR, so that you're comfortable. Not that you're going to need all of that to do the deal, but you just want to be comfortable. If you have 50K, you can do whatever you want. Flip, wholesale, BRRRR strategy, park a little bit of capital into a turnkey rental, boots on the ground program, like whatever you want. So it depends. So I say just get started and kind of scale up from there. If you're starting with less than 10,000 or less than 5,000, you typically want to look into creative financing. I won't just limit it to wholesaling, but creative financing. You can still acquire cash flowing rental properties with creative financing. So without having tons of cash or credit, you can still do cash flow deals, even some deals where you're not the landlord and you're collecting cash flow every month. And we teach those in our group course. Our group course is pretty cheap. It's only $500 if you catch it on a sale, which reminds me, I need to refresh that link. So if you catch that on sale, it's like $500 to get into that group course. We have the one-on-one mentorship program that focuses more on people who are ready to like scale or invest out of town and want to get to the next level. I'm going to tap out, answer the next question. And the last thing I'll touch on is just, you guys want to put yourself in the right bucket. So if you're starting off with less than 10,000, focus on creative financing, focus on going after motivated sellers so that you can, get yourself in the game. If you're starting with more than 10,000, start to entertain the BRRRR strategy or some of these other strategies out there, co-living, group homes. I know, Petrinia, you're interested in some of those strategies. We'll talk about them. Book a call. We'll talk about some of those strategies. You might be interested in some of them. And I think you could be good at actually some of those strategies. And then you can flip some houses and do some of those other things as well. If you have more capital to play with, you can invest out of town. You can tap into the Boots on the Ground program as well, as we have capacity. Right now, capacity is strained. So if I take on somebody in the Boots on the Ground program, it's going to be because you're an incredible fit. It's really a testament to you and like, hey, you're an incredible fit. I'll bring you in. Or you're already in a one-on-one program and you're like, hey, I need this deal. I'm going to bring you in, and just focus on getting you a deal. It's not easy to find you guys deals. It is not easy to get you a pennies on the dollar deal in this market, but it's doable, and we'll make it happen. You just got to stick with it, trust the process. The game plan works when you work the plan. I'll get to that question, Dame, and then we'll come back to that question because this is on the Boots on the Ground. Is the one-on-one different than Boots on the Ground? One-on-one mentorship and Boots on the Ground, how I'll break those down is like one-on-one is done with you. So it's like holding your hand through your first deal, but you want to kind of do it all yourself. And there are people out there like that who kind of want to do it all. Like, I want to do it. You connect me to some contractors, some architects, some engineers. Help me with the deal analysis. You guys can always tap into my deal analysts through the one-on-one mentorship program. You get one-on-one Zoom calls, text and email support. We do the mastermind calls. You get the 100 Keys Masterclass course content, breaks down how I went from 0 to over 300 properties in about 5 to 7 years using these strategies. And we talk about everything: buy and flip, buy and hold, short-term rentals, mid-term rentals, Section 8, co-living, group homes. We talk about tax benefits. We talked about credit repair and how to get yourself teed up, hard money loans, how to scale up, how to do it in town, out of town. We just break it all down, right? And then there's the boots on the ground is the done. I would consider that more done for you. So some people are like, Brian, I'm busy. Like, I was talking to one guy earlier today. He's from California. And he was just like, Brian, I'm busy. I'm making good money. And I'm tired of paying all these taxes. He's like, I got hit with like a couple $100,000 in taxes. And I want something that can be cost effective, allow me to invest in a cheaper city, but to really build cash flow and tax losses. And the Boots on the Ground program could be a good fit for him. He likes 101 because he likes to do it himself as well. But the Boots on the Ground could be a good fit if you're like, you want to invest out of town in one of these cities. You know that we got this in Philly and one of the top 10, and we can build you some cash flow, and you can kind of sit back. Where the Boots on the Ground, it's like, we're finding the deal for you. We're connecting with the lenders. We're building the houses for you. We're building the rehab budgets. We're doing it all for you. We're knocking it all down for you. And then when it's done, we're finding the tenants. We're managing it for you. It's completely turnkey. So it's a done for you model versus a done with you model. And it just depends on what you're looking for. Some people are looking for done for you. Some people are looking for done with me type of a model where you have that one-on-one focus and support that's going to scale you to the next level much faster. So it just depends. It just depends. So that's kind of that. Here's a question from Dane. How many employees does it take to run the old folks home that you spoke about? Yeah. To run like a senior housing facility, a residential assisted living facility, it depends on how large it is. But I think you'd be banking on about 5-6 employees. Your payroll is going to be high. Let's say if you had a 10-bed facility or 11-bed facility, probably have 10 people occupied because the average stay is only like a couple years. So there's always going to be some in and out. Probably going to have about 6-7 employees. Your payroll, you'd have like 50 grand a month coming in, and your payroll probably be like 30 a month, maybe 35 all in. Because there's going to be payroll, and then there's going to be just the cost of doing business, food and wear and tear, maintenance, keeping the place stocked up, laundry bills. There's going to be different running your business types of bills. But even with that, one residential assisted living facility building can make you $10,000, $15,000, $20,000 a month. So taking your time, going a little bit slower, building one of these things, you can do one deal, $10,000 to $20,000 a month of profit coming in. That's a game changer. For a lot of people, that knocks you out of the 9 to 5 right there. Then you get 2 of them, $40,000 a month. I'll tap out, come back and answer a question. So hopefully that answers that. You don't need a ton of employees to run one. It's also a reason, I'll wrap that up. It's also a reason why you want to nest around yourself. So you want to, if you're doing senior housing, you want to get like 3 assisted facilities, residential assisted living facilities all around each other. So you want to get 3 in the same zip code, because then you can take some of those employees and you can split their time amongst multiple facilities. So you can get the economy of scale. That's going to lower your carrying costs and increase your profitability long term. So that might take your profitability from 15,000 to 20,000 per building because you're splitting your cost there. Get 3 of those, 40, 60,000 a month. I don't know anybody who can't live off that. If you can't live off that, you got a bigger problem. Do you recommend any real estate accountants for taxes in the Northeast? I mean, I have a decent group, but I'll say not necessarily. I mean, you just want to find a group that works for you. Get your cost segregation study analysis done probably separately. Most of your real estate accountants, they understand cost seg analysis, but they don't necessarily do it in-house. There are going to be some specialty groups that do it, some that do it cheaper than others. So you just want to shop around like anything else. Interview, talk to a bunch of groups, pick the one that has the best fit. I'll say with accounting groups, you want to pick somebody who has a big enough team to support. Like my accounting group, if I handed them my taxes on, April 14th, they'd be done by the 15th and submitted. If I handed them like everything, because they have a team that is just massive and they can handle it. What you don't want to do is be in like some mom and pop shop where you hand them everything and they're like slow, delaying you, pushing back, and never getting to it, because it just jams you up long term, in my opinion. So guys, a lot of stuff we talked about today, a lot of value. We broke down a bunch of the mentorship programs and all that stuff. If you guys have any more questions about that, you know how to get a hold of me. Just reach out, shoot me a text, and we'll go from there. I'll answer a handful more questions and then we'll wrap it up. We're running almost at an hour and a half. Do you still get to use all the tax benefits like depreciation when running the senior housing play? Yeah, because when you're running that play, you still own the real estate. You still own the real estate. So yes, you're getting all of the real estate benefits and all the cash flow coming out of that asset as well. So you're getting a good mixture of both. You're getting a good mixture of both. And a lot of people argue when you're running that senior housing play, you're buying better real estate, arguably, because you're not focused on cash flow. You could go out. The game is to buy in a nice area, a rural area. So you're not buying C-class. You're not buying in the hood. You're not doing any of that. You're not buying low value real estate and value adding it to improve it. You're going to go out and buy in an A-class in a rural area, basically like where the median income is high. It's double where the median income there is double the average for the general area. So if the Philadelphia median income was 50,000 and I go to the suburb outside of it and now it's 100,000, the people who live there, their parents, they want their parents to live, if they age into an adult residential assisted living facility, they want their parents to live 10, 15 minutes away, right in the community. So you buy right in the community. You might buy that house for 600,000, but it doesn't matter because even if it has a $4,000 a month mortgage, this building's bringing in 50,000 a month. So it doesn't matter. And that property should appreciate in value long-term substantially. So you're going to get big write-offs, massive depreciation, but you're also making big money. I mean, you're making 20 grand a month. That's $250,000 a year off of one building. You get 2 or 3 of those. I mean, you're cash flowing like 750,000, $750,000. It's big business. And then what you would do is take that profitability and then park that into the BRRRR strategy to get even more tax losses and deductions, or park it into a commercial building, a 10 unit, 15 unit. So it's a gift that keeps on giving. It's a gift that keeps on giving. So it's, one of the ways you can do it. There's other ways you can do it, but I recommend having multiple strategies, multiple streams. So you might have a BRRRR strategy stream. You might have some Section 8 portion of the portfolio. Then you have some residential assisted living portion, or some type of alternative portion. Or you might say, I don't want to deal with the senior living. Give me that co-living and I'll do some Section 8 and then mix that up, because I want to run a little bit faster and with less overhead and less employees or different people. Because the senior living approach, it requires more management. It's less passive. It's more active, but more cash flow. So it just depends on the lifestyle you're trying to build and what you're trying to build. For some people, they'll take lifestyle over more cash flow. They're like, 20 grand is a lot, and that's cool, but I'll take 10 and have it be more passive. So it just depends on who you are. This is why I love real estate, because you build the real estate around you. And this is why I do one-on-one mentorship, because I can design the plan around you. It's not cookie cutter where it's just like, here it is. It's really, there's multiple strategies, and we need to pick the strategy that works for you and then build it. Tap out, tap back in if anybody else has a question. So guys, hopefully that helped. Hopefully you got value. If you got value, like, comment, subscribe. Leave a comment that says I subscribe, and share the content with somebody else who you want to get value. We dropped a lot in this, so definitely plenty of room for somebody to get value. This will be the last question we'll answer, and then we'll call it. Would it make more sense to run that out of a commercial building, like a 5-unit, since that would be based on the income, or keep it residential? It depends on your question, but residential assisted living facilities are valued differently than your typical single family property, even though it still could fall under like a group home residence in a single family zoning area. So no, you're better off just doing it in a larger single family property. You typically want a minimum of 300 square feet per resident. So for a 10 unit facility, you want at least 3,000 square feet, but preferably like 4,000. So you want to go on the bigger side of things. You don't want to be too small with your facilities. Go get a big building, convert it into a nice group home. Heck, you could even do that group home play with co-living, and that'll be a little bit more passive, less red tape, definitely no employees and management, and you can still cash flow like 3,000 to 5,000 a month off of one of those. So that could be another play and another wrinkle. Definitely, guys, I dropped a training video on this stuff on a YouTube channel. It's called the best strategy. I titled it the best strategy in real estate, and it has 3 high cash flow strategies. It talks about all these strategies that we're talking about right now. Apply your focus to them. If you like them and you need help with them, reach out. But these things are serious business. It's serious business. So going slow, taking your time to learn the right strategy that fits you, can be better than going super fast and doing a strategy, getting results, and you will get results. But to me, it's about finding the right fit. That's why I do one-on-one mentorship. It ain't easy to serve you guys in a one-on-one format. It's not easy to respond to texts and do quick phone calls and do one-on-one Zoom calls and all the things I do for you guys who are in the one-on-one mentorship program. It ain't easy. And that's why nobody else does it. You're not going to find anybody else to do it at the price point that I do it at. You won't. I challenge you, go find it. You won't. But it gets results. It gets results. Even for some people who are, like, I just had somebody tap in. They were in the one-on-one mentorship program. They kind of faded. They just reached back out like 6 months later, like, I'm ready. I'm locked in. I'm focused now. And it's like, good that you're focused. I'm still here. And, we'll get you locked in. So people will get results at different times. But one-on-one works if you put in the time, if you stick with it, you will get results. And you only need to get one successful deal. One successful deal will cash flow you for life. And once you do it one time, you can do it 100 times. It's the same thing over and over again. So guys, hope this helped. Like, comment, subscribe. Drop a comment. Stay tapped into the channel. Reach out about the ride along. If you're still afraid, you have fear about construction, how to get into this game, join me on Saturday, March 23rd. It's on a Saturday. I don't want to hear about your job and all that. It's on a Saturday for a reason. Come out to Philly, stay in a hotel, see the city of brotherly love, understand this real estate game, spend a day with me and other people just like you from all around the country who are tapping into this game. More importantly, for some reason that gives people more confidence than even spending the day with me, seeing other people like them that are early in the journey but are tapping in. And become a part of the movement. Get yourself some cash flow and put your family first. Break free from that 9 to 5. Get your time back. Take your time back. Stop giving your time away for money. Stop staying in that rat race. It's not going to work out for you if your only plan is to get one stream of income where you give your time away, because you're going to run out of time and then it's over. Hope that helped. Brian Grimes, your real estate mentor. I'll see you guys on the next one. Reach out, text me, DM me. I'll talk to you guys.